And not good. All right.
China slowing down, of course, affects Asia, affects the world.
China's Evergrande, because the slow-motion collapse of the world's most indebted property developer has just entered a new stage. The embattled company has filed for bankruptcy protection in the US, while its restructuring plans are being carried out elsewhere. Meanwhile, signs of trouble are spreading.
China finds itself grappling with economic challenges, making its people worried about the nation's future. The immense debt surge that emanated from the US and Europe after the 2008 financial crisis seems to have reached China's shores. Certain experts believe that the era of unceasing Chinese growth has drawn to a close. Despite holding the global position of the second largest economy, the country's financial system is falling apart. The problem of youth unemployment has become so big that the official news about it has been stopped. Furthermore, the spectre of a graver property crisis than before looms, and yet another major property developer in China teeters on the brink of default. So, what's happening with an economy worth $18 trillion? And why is it important for the United States? Stay tuned till the end of this video to find out. Until recently, China was on an unstoppable path, or at least seemed so. This was because for the past 3 decades, China led the way in manufacturing, global investments, and swift productivity. The expanded global trade and foreign investments helped elevate over 400 million people from poverty. Moreover, China's economy has grown to be 11 times larger than it was in 2001. And they were even called the economic miracle as they were growing faster compared to other countries. However, now, the famous Made in China is in the doldrums. Firstly, because of youth unemployment, which is so bad that they stopped reporting it on media. The whole situation actually began in 1998, when China expanded higher education. They increased their budgets to build schools, hire teachers, and give scholarships to needy individuals. The goal was simple: to have a smart economy, fill the need for educated workers, and make China strong globally. For that, Chinese universities took in about 1.6 million students in 1999, up 47% from the year before. They made higher education more common, even for rural or poor students. However, there's a problem now. More people got degrees than there are jobs for them, so many young Chinese people are jobless. Right now, the unemployment rate for people aged 16 to 24 is 21%. Going up every year since 2018. It's so bad that young people are buying lottery tickets 50% more because they think this is the only way to make money now. China, of course, disagrees with these claims and states that there's a misunderstanding, and they're still looking at the unemployment rate. They say the surveys used for collecting data need more work to be better, but many think they're just trying to make things sound better. The story doesn't end here, as China faces another problem: the real estate crisis. Over the past 10 years, China has faced a huge real estate bubble. You see, their people like to invest money in property for safety, causing prices to go up by double digits each year. Actually, China built 5 times as many homes as the United States and Europe combined, but there was still not enough. Some cities even had a lottery to decide who gets a home, with odds as low as 1 in 60. This made 70% of the country's money tied to real estate. During that time, property values went up so fast that developers would sell units before the property existed. People paid a lot, sometimes up to 23 times their yearly income, to buy a home on a mortgage, even if it meant more than half their pay. They borrowed money from friends and family just to say they own a home. You can probably guess what happened next. The real estate market became so popular that prices increased 700% from 2001 to 2017. So, to slow down the rise in prices, the government introduced more rules to limit who could get a loan. They said houses should be used for living, not for making money, but this action came too late. When China's economy suddenly became slower, property builders struggled to get finances to continue their projects. They couldn't finish all the homes they were building, and that led to the big real estate company Evergrande's bankruptcy. The company has asked for legal protection from creditors in a US bankruptcy court in Manhattan. However, things started quite well for them. Evergrande seized the opportunity presented by China's real estate boom and emerged as one of the nation's leading property developers. Back in 2018, they even held the title of the biggest real estate company in Asia. But there is an end to everything good. The company's extensive operations often involved intricate practices. In simpler terms, Evergrande would typically lease land from local governments and then sell houses planned for construction, receiving full payment up front. Demand was so high that people eagerly bought homes using mortgages, aspiring to own property. However, a significant issue arose. Instead of using the sales money for construction, companies like Evergrande used it to secure more land. This enabled them to sell more homes in the future. Now, this is a huge problem. Perhaps the most concerning aspect is that Evergrande wasn't alone in these questionable practices. Virtually all real estate companies in China were following this pattern. Hence, the entire sector was heavily burdened with debt. In early 2021, a subsidiary of Evergrande couldn't fulfill its loan payment, leading to a deeper scrutiny of its finances. The revelation that Evergrande might default on a $300 billion debt triggered economic panic. It became evident that the issue extended beyond Evergrande, encompassing the entire real estate sector, which was buckling under excessive debt. Many view this as the conclusion to the Evergrande story. However, this marks merely the start of the downfall of China's property industry and its economy. However, in response to this, China began reducing its interest rates to encourage economic growth. But much like past scenarios, this often proves insufficient. With over 50 developers already facing financial struggles, this has led to another economic crisis: deflation. For those unfamiliar, deflation is the opposite of inflation. Prices decline instead of rising. Though it might sound positive, it's not. Lower prices usually indicate weaker demand. When money gains value over time, people are less likely to spend it, leading to further price drops and a repeating cycle. Eventually, companies cut back, produce less, and the entire economy plunges. And lastly, the final strain: a shadow banking crisis. Unlike traditional banks which follow stringent rules, shadow banks operate in unregulated sectors like hedge funds, private equity, and investment banks without the usual constraints. However, don't misunderstand. These shadow banks don't function like regular bank accounts with deposits, checking, and savings. Instead, they mostly serve businesses, funds, and big investors seeking higher returns. Unfortunately, many of these returns were tied to the real estate market, which, as is evident, is facing challenges. And this brings us to the present day. One of China's major shadow banks is now being closely examined due to its failure to make payments on 3 publicly traded companies. This has led to protests outside its offices in Beijing. What adds to the severity is the strong possibility of contagion affecting the entire market. When payments are missed, companies don't receive their money, leading to potential setbacks with their investors. This chain reaction could have a cascading impact on the entire economy. Regarding their official statement, a possible source mentioned, "We can't make any public announcement right now. The primary reason is that we're still actively evaluating our underlying assets and working hard to recover them for you. If we disclose the assets for a specific product, it might significantly reduce the assets. We can't do this as it would be irresponsible." However, this is a genuine issue that deserves sincere consideration. When considering the potential impact on the United States, it's important to note that there is minimal connection to China's financial crisis. For example, analysis indicates that the United States holds around $215 billion in direct investment in China, coupled with $300 billion in portfolio investments in their stocks and bonds. In total, this adds up to about $500 billion in direct investment. Despite sounding substantial, this pales in comparison. The US stock market's value is $46 trillion, while all real estate combined is worth $43 trillion. US office buildings, often deemed the center of the next financial crisis, account for $2.6 trillion. To put it simply, US exposure to China represents a minute fraction of a percent, unlikely to significantly impact its economy. Furthermore, it's also mentioned that China's effect on US trade is less than 1% of its GDP, making a big impact on consumer demand unlikely. Instead, a larger worry might be irrational investors getting worried over nothing and causing a short-term selling rush. However, it's worth noting that situations like this aren't entirely rare. Ultimately, this reminds us that China still has a long way to go if it wants to surpass the United States and perhaps replace the US dollar in the future. That's it for today. And now we invite you to share your thoughts in the comments. Do subscribe to the channel if you like our content. We will catch you in the next one. Bye.